All right, everybody, continuing on with the notes now for Chapter 5, we're going to get into budgeting at this point. Budgeting, usually an annual process in which management projects anticipated revenues and expenditures for the firm for the following 12 months. Now, most of the actual budgeting process takes place several months before the new budget year starts. So, let's just say that the budget year happens to be the calendar year, January through December. A lot of businesses don't do their calendar that way, but just for simplistic purposes. Let's say, so in order for us to be ready for the new budget come January 1st, we need to be thinking ahead pretty well in advance about what that year is going to look like, including analysis of the current year and perhaps even years past. So we're really going to start looking at those numbers and trying to make some assessments somewhere 3 to 6 months before that new year starts. So it is something that we're always looking at and always making sure that we have a check on. Now, once the final budget is approved, managers monitor performance at regular intervals. They'll do so weekly, monthly, quarterly, and use various types of financial statements to help them to see how things are going in light of the budget and light of the overall bottom line. Setting priorities and goals in individual departments is key to helping the budget work. Department heads normally submit an initial budget for approval to the controller and to the general manager based on the individual department's priorities and goals, and they make sure that they're in line with the company's strategic plan. So we've talked in previous chapters about mission and vision of the company. And we want to make sure all those things are in line with that, including the ways that we spend money. Do the things that we're looking to invest in actually help the company achieve its overall vision and its strategic plan? Each manager conducts a careful review of past performance of their individual unit, considering revenues and expenses as well as equipment, personnel, and other needs. If a department knows that it's going to need to make a significant expense to replace some sort of a computer system or a piece of expensive equipment, that's something they're definitely going to want to bring up, because that may require some sort of adjustment in the budget, either in reducing other expenses within that department or reducing expenses in another department in order for that significant purchase to happen. The submission of a department budget is usually accompanied by a report that summarizes the budget and justifies each expense. So usually, in addition to getting a list of items and the numbers associated with those items, there's going to be this sense of what the purpose is for wanting to spend that much money. Why is there such an increase in this one particular line item? Or is there something that's showing up that's brand new that's never been there before? What is the reason for that, so that we get a better understanding of what the needs are of a particular department in order for them, at least in their minds, from a equipment, personnel, resource standpoint, to be able to run properly. Now, capital budgeting, this is something that's a little more of a distinction when we think about how we budget for capital expenses. When we're talking about capital expenses, we're talking about things that usually require a good deal of money, as something that we're doing as a long-range purpose that we're hoping is going to last us several years. Some of the things that would be covered under capital expenses would be real estate, large equipment like vehicles or machinery that is rather expensive and involved in its use, and sometimes in its size as well. But those sorts of things do involve a separate budgeting process. So capital expenditure budgeting is defined as the long-range planning, evaluation, and selection of projects covering more than one fiscal cycle. So even if the purchase of some sort of capital expense happens in one lump sum, the way that we deal with the value of that may actually go through several budget years. And we'll kind of hit a little bit more about that as we go on through the chapter. Now, compiling the budget, the GM can reject any budget items deemed unreasonable. And in compiling the overall budget, the GM should explain to the department heads what areas of their proposed budgets are being cut or being modified, and hopefully give some sort of a rationale as to why that is happening as well. This helps those managers of those departments to be able to reassess and reprioritize, or at least come to an understanding of why funds that they're requesting or they're not there. The GM must also evaluate any capital expenditures requested by individual departments. The GM prioritizes these requests, and through the use of capital budgeting techniques and other analysis, determines which projects, if any, can be pursued over the next calendar year. So there is this sense of, just like we do at home, if there's too much month at the end of the money and we have to decide if we're going to eat Lucky Charms or we're going to eat Walmart Great Value brand Cheerios or whatever we're going to do, we're making those decisions. But in the budgeting process, we're kind of forecasting and trying to mitigate those things before it happens in the middle of the month, in the middle of the budget cycle. Once the budget is finalized and approved by the general manager, it then moves on to corporate for final approval as necessary, or in the case of a smaller operation, the owner of the company. Budgetary flexibility. Successful budgets contain a degree of flexibility. Most managers will designate a percentage of the budget as a reserve account to cover emergencies or unexpected contingencies. This could be as simple as putting a line item on the budget that says miscellaneous, or it could also be that several departments are budgeted for a lesser amount in hopes that they can meet that lesser amount. But if there is need to be able to spend more, then there is some overflow funds that were not necessarily accounted for in the budget itself. Budgets also help management project estimates of future revenues and expenses. This part of financial management is known as forecasting. So they're trying to make a projection of things that are going to be coming up down the road and being prepared for those sorts of things. If they know that there's going to be a major expense coming up 2 or 3 budget cycles from now, they would plan now to be able to have funds in reserve to be able to meet those needs. Perhaps even taking those funds and putting them away in some sort of a short-term investment or something like that, in order to make the money work for them while they're waiting on that particular purchase. Monitoring financial performance. All financial transactions are recorded in accounting software that mimics physical journals and ledgers. This information is then summarized and reported in financial statements. Now, basically, what you need to know about that from an accounting perspective, even if you're not the one that's physically crunching the numbers and putting in the journal entries and that sort of thing, it's helpful to have a basic idea of how accounting systems work in terms of, at the very least, the information that you're looking at and what it means to you. A couple of distinctions. Typical journals include cash receipts journal, cash disbursements journal, sales journal, and a general journal. General journal is basically kind of the master list, if you will, of all the debits and credits that happen within a company and what categories those debits and credits come from. Those categories in accounting is called a chart of accounts. So each account would be a category that we are budgeting for, or that we have, a certain bank account would be an account, a certain liability or loan that we have, that would be an account. Different expenses that we have, those are accounts. So each of those categories where we could say money came from or is going to that category is considered an account. Ledgers usually consist of accounts receivable, accounts payable, the payroll ledger, and the general ledger. So basically, these sorts of things help to show where the money is coming from, where the money is going to, and you can get a sample list of what some of these things do in particular in your textbook on page 95. Now, let's talk about some of the financial reports. The three that we're going to talk about that you're going to want to pay the most attention to. These are the three reports that every business needs to have some semblance of in order to maintain good accounting practices. The first one is called the balance sheet. Balance sheet is also known as the statement of financial position, especially if you're dealing with like a nonprofit sort of company. They'll call it that as opposed to a balance sheet. But what the balance sheet does is it summarizes the financial condition of a firm at a particular point in time, allowing management to compare conditions at different intervals. So it's basically the idea of taking a snapshot. What is happening in our finances on this particular day? And basically what the balance sheet does is it helps to show the balance between the assets of a company and then making sure that that is equal to the liabilities and equity that are in the company. We'll talk about what those terms mean in just a second. To look at a sample balance sheet, turn in your textbook. There's one on page 96. Now, those three terms that I mentioned. Assets, this is anything of value that's owned by a firm. So this would be anything from actual cash in the bank to real estate, real property. It would also include any accounts payable, monies that are owed to the company by clients. That would all those things would be considered assets. Liabilities represent debt to others, basically money that the firm owes to other people. So those are the liabilities. And then the owner's equity refers to the financial interest held by the firm's owners. That's the investments that the owners or the stockholders make into the company and basically provides a sense of the net worth of what a company is. Assets fall into three different categories. There's current assets, or sometimes called liquid assets. These are considered first when one discusses assets because they represent items that one can convert quickly into cash. These are things that either already are cash, it's money in the bank, or things that could be sold and in a fairly easy sort of manner and turn into cash that helps to consider a company's net worth. So current assets are those sorts of things. Property, plant, and equipment, also referred to as fixed assets. These assets are usually held long-term and cannot be converted quickly into cash like current assets. So real estate would also be something here because it's a process to be able to sell real estate to somebody else. So anything that has value that you can't necessarily just, go on Craigslist and sell it off, that would be considered a fixed asset. And then intangible assets. These consist of things like patents, trademarks, copyrights, any sort of prepaid expenses, all those sorts of things are going to be intangible. It's not something that, by most considerations, are things that you can sell, but they do have value and add to the value of the company. In the electronic and digital media industry, several important assets fall into this category. So that would be the station license, because that license is assigned to a company in order to sell a TV or radio station to another company. The FCC has to get involved. It's a process. You also have network contracts for affiliated stations. You have franchise agreement for brand recognition, all those sorts of things. They have value, but they are fairly difficult to transfer the ownership of those things, even though they do have a significant value. Programming and advertising contracts also are considered assets. So all these sorts of things that a company owns and has some sort of value to it, these things are assets. Tax regulations require all companies to deduct the value of their fixed and other assets over time through depreciation and amortization. Fixed assets are depreciated and intangible assets are amortized. We'll talk a little bit more about amortization a little bit later on, but the main thing to know there is that what we're talking about is how assets will tend to lose value over time, or that the asset's value can be spread out over time. So depreciation is that idea that something reduces in value over a set period of time. Intangible assets, we consider what we think of as the lifespan of that particular asset, and that's how we determine its worth over several cycles. Now, we talked about assets. The other part of the balance sheet, number 2, is liabilities. Liabilities that can be eliminated in 1 year or less are considered current liabilities. Those that will take a year or more to fulfill the obligations of, those are called long-term liabilities. So things that you would have like a multi-year loan for example, would be considered long-term. Anything where you could write the check and pay it off today or pay it off within a short period of time, that is considered a current liability. So the third part of the balance sheet is owner's equity. And that is, again, the investments that owners or stockholders make into a company. Now, besides the owner's initial investment in the firm, owner's equity includes earned income. This is also called retained earnings. And this would be money that has not been dispersed to stockholders or other parties. So this would be any profits that are made but have not been paid out to owners and interested parties. This part of the balance sheet reports the amount of equity held by the owners of the company and any capital surplus. So this is also where we see not just how much money the owners have at this point that is sitting within the company coffers, but we also see the company's net worth. Income statement, also known as a profit and loss statement or a P&L. It's also called the statement of operations in a nonprofit situation. But basically, the income statement charts a firm's financial activities over a set period of time. This will usually be over the course of a week or a month or a quarter, which is a period of 3 months. And you can see a sample income statement in your textbook. While the balance sheet compares how a firm operates from one time period to the next, the profit and loss statement or the income statement identifies where changes in the financial condition of the firm took place. So you're able to see by looking at the income statement where increases and decreases in value happened from category to category, from account to account. Now, the third major document that we tend to look at when it comes to financial reports is the cash flow statement. Managers will use a statement of cash flows to track the flow of money in an organization. This statement summarizes the sources and the uses of the cash flows in an operation, and it presents the beginning and ending cash balances. So in a way, it works similar to the income statement, but you tend to be able to see the delta, if you will, the difference from one point in time to another point in time. And again, you can see an example of a cash flow statement in your textbook. They're going to generally break down the cash flow into 3 different main sections: operating activities, investment activities, and then financing activities. And you'll see how those things break down under each of those individual areas to be able to determine where your money is coming from and where your money is going to. Sales prices for media properties are routinely based on some multiple of annual cash flows. And what this basically means is that when a station goes for sale, the value of the station is generally determined by how much money the station is bringing in versus its expenses, which is essentially what cash flow is trying to show. So that's how they basically try to determine that. And they'll take a look at projections of sales revenue. They'll look at various expenses and things like that. So it can be determined depending on the market, depending on the medium involved, depending on forecasting of how things are going to happen in the years to come, that you could find that a station could be anywhere from 3 to 10 times cash flow, the amount of money that's being transacted over a period of 3 to 10 years. So if you've ever wondered how they determine what the cost of a station is, in very simple terms, that's how that happens. Some other financial statements that might be of interest would be statements that give insight into changes in owner's equity, retained earnings statements, statement of financial position, and specific company projects, where you're looking at special things that are happening within the company and seeing how well those things are doing by themselves, as opposed to being locked in with all of the company operations and the finances as a result there. One other thing to note here is the Sarbanes-Oxley Act of 2002. If you have heard of companies like Enron and some of the scandals that have happened in some of these larger corporations in the 1980s and 90s, this legislation was a result of some of those things. Basically, what the act does is it tries to bring a certain amount of accountability to corporate financial statements and the disclosure of those things. And the big thing is that there's a requirement that the CEO of a company signs off on the truth and the validity of the company's financial statements, so that there's not a second set of books, if you will, or they're not trying to artificially inflate or deflate numbers in an attempt to make the company look better than what it is, or to look worse than what it is, that the reports that they put out are truthful and honest and accurately represent the financial situation of a company. So as a result of that, you're going to have different things that are happening within a company when those reports are being offered, especially on an annual basis. It's not uncommon for companies to have their books audited by a independent certified public accountant in order to make sure that they are basically holding up to that truth in disclosure standard that's required by the Sarbanes-Oxley Act. This is a good place for us to take a break, and we will finish up the chapter in the next video.